Good afternoon. Uh, can't believe it's already August, but thank you for taking time out of your day at the start of, I'm sure, a busy week to join us for our Q2 analysis. My name is Sean O'Brien, the president of QwickRate, and as always, I'm pleased to be joined by David Ruffin. David will take you through the second half of today's presentation with a focus on credit. Just a reminder, we will send out a link to today's recording along with the copy of the slides. We do have a few polling questions, so we'll include those in the email as well. Certainly use the Q&A feature or the chat feature, and we will monitor those through the presentation and take questions either in the midst or certainly at the end. And again, thank you all for joining us today. We'll just, I don't know how you feel about 2024, but it feels like we're kind of meandering a bit. Things are just been a little bit sluggish, but we'll take a look at this QCBI results today. As I mentioned, David will give a credit update and an outlook, and then we'll talk a little bit about what we've got new at IntelliCredit and QwickAnalytics as well. As always, we'll start with a few polling questions. I think we just have 4 today, so certainly appreciate your participation in these. But we'll get these started. The first one is regarding margin improvement. Where do you expect to make the most improvement to margin over the next 12 months? So just a single choice. Obviously, we'll be working on all these, but where do you think will be most impactful? Cost of funding, pricing of loans, growth of loans, cost savings. So we'll give this a minute or so. Okay. Appreciate everybody answering that one. We'll go ahead and end this one and share the results. So most impactful is cost of funding, then pricing of loans and growth of loans equal, and then cost savings next up. Right. The next question is regarding, whoops, let me stop sharing that. What's this next one? Are you experiencing any increase in your past due loans? So again, we'll just go ahead and give that a minute. Got a chat here. Oh, hopefully, Michael, the poll's showing up now on your screen. Okay. Go ahead and end this one again. 68% of you are not seeing an increase, so that's good to see. 32% are seeing that. Let's see. The next one, just regarding your budget, are you currently ahead or behind on your 2024 budget? Just a reminder, if you have 2 monitors working, maybe the polling questions are on the other one. So just thank you, Lori, for that suggestion. We'll go ahead and end this one. Share. So 45%, good to see, ahead of budget, 27% at budget, and 28% below budget. So appreciate everyone's response there. And then the final question today is around CRE. Which of the CRE subsets concerns you the most? Industrial, warehouse, office, 1 to 4 family, construction, multifamily, retail, or hospitality. So go ahead and end this one. Again, appreciate everybody's participation today. Office is leading the way at 49%, and then 1 to 4 family, construction, retail, and hospitality. So again, we'll include these in the email, but as always, appreciate everyone's participation in these, and we will continue moving forward here. Just I wanted to kind of continue the focus on uninsured deposits. I think it's important that we're able to demonstrate our coverage or have capacity of these uninsured amounts. So again, I don't know what I'm looking for here, but I just think, again, since we know it's a focus, just want to keep reminding you how many, banks and what the level of uninsured is. And so you can see that, that still over 1,200 banks have 30% of their deposits uninsured. But it does feel like in conversations, it is a question that a lot of, regulators want to make sure banks have capacity and coverage to make sure they can plug that hole if those deposits were to move. Again, I think our continued new normal for deposits, are really, again, I think, increasingly are going to be critical to our future success. And, and again, our best customers are going to remain targets of other financial institutions and fintechs. And so I think it's important for us to continually, revisit and monitor, where our growth for deposits will come from. Will it come from new customers? Will it be a try to appeal to larger wallet share of our existing customers? But again, continually trying to focus on where that growth is going to come from, I think is going to be critical for all of us. I also think it just revisiting our assumptions as we move forward. It feels like we're maybe at that tipping point a little bit where we'll finally start to see a drop in rates. But what will we, where will our mix and composition of deposits come from? Will there be lower growth in lower yield deposits? Probably, likely. Certainly going to be higher competition for higher yielding products. We're probably now, with cuts in rates coming, we'll probably start to shift, or our customers will shift their focus to savings and time deposits in a way, maybe move a little bit away from money markets. We'll see, and probably look for, potentially a little bit, maybe shorter durations, but maybe they'll try to lock in. Again, our customers never really lock in for too long, but we'll see. We'll see what happens with durations. Again, I think it's important to revisit what our strategy is to gather these deposits. What's our approach going to be? What types of services and tools are we using? Are we using digital marketing? And then also, again, I think deploying as many sources of wholesale funding is probably in our best interest. For the remainder of 2024, I think it's pretty, it looks more likely this quarter that we'll see some cuts, maybe starting in September. The Fed, while still trying to reduce their balance sheet, the Treasury is still expanding the borrowing, so they're kind of mitigating or offsetting some of the effect of each other. The rate of inflation is clearly slowing. There was a report out from the New York Fed. Expectations over the next few years, are certainly continuing to trend down. Some areas of the country are, housing continues to be sluggish. And then I think, the trade-off that the Fed's playing with, right, is, unemployment, even though it's at multi-year record, multi-decade lows, right, it's still probably going to tick up a little bit here, which will have the effect of probably increasing or just slowing inflation even a bit more. So, I think we'll continue to see pressure on deposits. I think we'll see in the numbers, we saw deposits tick up a little bit here this quarter. So that was good to see. We're probably going to be lending into maybe a little bit softer market. Improving our loan and deposit approach is probably will continue to be critical. In our analysis of the top performers this year, loan pricing was a critical component for those high-performing banks. Being able to pass along market pricing really has made a meaningful impact for those banks. And I think we probably have to expect, a continued heightened regulatory focus. I think David will touch on, what they're seeing in their loan reviews. I think, again, liquidity will continue to be in focus. But certainly, I think given the lessons of last year, I think these next, couple of rounds of exams, we have to probably expect a little bit greater scrutiny than we've seen over the past few years. I've been updating this chart for a number of quarters now. Hopefully this was actually a little bit of improvement this quarter. I would think more hope and relief is on the way if rates come down. But you can still see the number of banks who, because of their securities portfolios being underwater, where they stand in terms of tangible equity to tangible assets. So we'll continue to monitor this, but at least for a quarter, we did see some improvement, and I would expect improvement in this through the end of the year. So let's jump into the QCBI numbers. So here you can see asset growth. For the last 12 months, again, 28% of the banks haven't seen any asset growth. At the median, we did tick up a little bit, so that's good to see. Loan growth, excuse me, trickled down at the median. Again, 15% of the banks didn't see any loan growth, but we did see a fair number of banks experience over 10% growth. So kind of a strange barbell, but nearly 60% of the banks have seen better than 5% loan growth over the last 12 months, which is certainly encouraging. And you can see in the bottom graph, kind of equally realized across asset sizes. Deposit growth, good to see that it ticked up here again at the median. You can see, still concerning, a third of the banks didn't see any growth over the last 12 months. And in that bottom chart, the smaller banks in particular, 0 to 100 and 100 to 250, really, again, trying to drive deposit growth is increasingly challenging. A pretty strong slope here, in terms of size and the ability to gather deposits. Not surprising, but again, as community bankers, that's what we're up against. And I think, again, just kind of reiterates why my focus these last couple of quarters or a few quarters has really been on deposit growth, just because, again, I think for all of us, it's always important to our franchise. But I think ever since Silicon Valley, it's in these higher rates, it's just going to, again, amp up the spotlight and the pressure on us to be able to continue to try to generate deposit growth in our franchises. Some performance numbers. So you'll probably notice we did finally get updated. We've expanded some of the reporting on these. Some of these charts didn't have the median yields and the QCBI breakdown. So this is a page where we actually broke that out this time. So you can see the yield on loans ticked up very nicely here this quarter and then over the last 12 months. And you can see the kind of the breakdown of where yields are for banks. And I think to the far right, the median yield, right, really strong pricing for the smaller banks. But we also have to recognize that the larger banks are willing to buy some of their business at times when necessary and are able to deal with median yields much lower than the smaller banks. Cost of funds continues, unfortunately, to rise kind of across the board. And again, to the same point, the larger banks are willing and can afford potentially in some cases to pay more for those deposits, which again, I think is a trend we just have to realize is the fight for deposits is going to continue to be challenging, particularly for some of the smaller banks. NIM, again, contracted a bit. We've kind of stabilized here. You can really see over the last, 4 years-ish, we've been, just kind of stagnant there at the median. And then again, based on size, smaller bank who rely completely on NIM, still holding strong at the median there at 356, which is nice to see. In the bottom charts, non-interest income continues, it's slow down here over the last few years. But the larger banks still a pretty strong number there at 58 basis points. The smaller banks obviously a bit lower. Efficiency ratio went up a little bit again, but to the far right, you can see the again increasing challenge for the smaller banks. Almost 8 full points of difference in efficiency between the 0 to 100 and the 1 to 10 billion. Again, the most common and the most highly correlative component of high-performing banks is the efficiency ratio. So again, being able to continue to work at this and whittle it down, obviously critical for all of us, and certainly not telling anything anybody doesn't know, but just kind of highlights the trend has been higher here over the past few years, but is stayed in a pretty tight range. So good work being done by everyone. Profitability, pre-tax ROA median at 108, median core operating earnings to average assets at 117. Again, slowly and slightly trickling down over the last 12 months and over the last couple of years. Hopefully we're getting to the point where this will start to bottom out and we'll start to see some improvement, going forward, but still, it's been a tough couple of years with those deposit costs rising the impact to not only NIM, but then obviously ROA and earnings, and then ROE as well. So you can see the median ROA at 85 basis points, the median ROAE at 9.25. But again, to the right, all medians, regardless of bank size, under 10% are a return on average equity. So again, good numbers, but demonstrating the increasing competitiveness and difficulty, with where rates are generating, strong ROE. A new chart we've added to the QCBI, and this is also at the state level. So again, this we had a comment in from Mike Tierney, a few quarters back, just about trying to kind of break down even a little bit greater detail from the median. And so what we've done is we've taken all the metrics that we track in the QCBI and just kind of put together a percentile board here. So you can see the median values for all those from which we just covered, but then you can kind of see what the range is within the percentiles of all of these, right? So you can see cost of funds, all the way at 111 going up to 318, NIM at 231 going all the way to 465. So again, it gives you a little bit of idea what banks are kind of experiencing across the spectrum. And then in the individual state reports, we have this broken down as well. So I certainly encourage you to go look at the QCBI for your state if you're curious to see how these numbers break down at a state level as well. All right. So at this point, I will turn the presentation over to David, who will take you through the second half of the presentation. And hold on, David, there's just one question here. So Eli had a comment here. Deposit growth remains a key topic. It seems relevant to point out that the cost of fund means the deposit growth is coming mostly from the P&L and not through more relationships or higher balances. So Eli, thank you for sharing that. Absolutely appreciate the comments. And again, everyone can see that in the chat. All right. So, all right, David, screen is yours. Oh, you're on mute, I think. I don't know if you...
Sorry. There we go. Let me be sure I share my
screen. Get that up there.
And then there we go.
Yep, I can see it.
All right. Let's go back to what I wanted to do. Thank you. Always a pleasure sharing this quarterly ritual with you, Sean, and also happy Monday to the attendees. I wanted to take the good news on loan growth, of course, and I will hasten to say that every part of this section for me remains kind of a vigilance issue, and Sean alluded to it. It's really around what we're certainly perceiving as heightened scrutiny by the regulatory community on credit and where it's going. It, again, continues to be performing at the published metrics at a quite acceptable level, but there are some trends of concern that I think most of you are already beginning to sense. As it relates to the loan growth in particular, which again was fairly robust for community banks in the last quarter, I wanted to peel the onion a little bit, and there is a little bit of dichotomy that is emerging between the larger banks, which is the chart that you see here from the FDIC. Unfortunately, the regulatory community is usually a quarter behind in terms of its ability to publish in real time what the previous quarter. So this is as of first quarter, but you'll see actually negative loan balances have basically for the entire commercial banking. That's obviously the mega banks and the community banks. The QCBI banks, which are 10 billion and under, community banks showing, frankly, robust loan growth. So actually, there's more loan growth occurring among the smaller banks as we sit today than it appears to be at the banking community at large when you throw in the larger banks. In terms of wholesale funding, again, this is what we do in the credit segment, as you know, is divide into about 6 regions of the country. And you see the legend at the top of this. In terms of wholesale funding, it's begun to level out. You've got really kind of bookends between the Northeast using the largest degree, almost 15% of its funding now is coming from wholesale. The Southwest is the least region at 6.5%. Somewhat related to that, of course, is your loan to deposit ratios. Not uncommon, perhaps, because of their dependence on wholesale growth. The Northeast banks appear to be the highest in loan to deposits. The Southwest, again, lowest. In terms of current delinquencies, and this is off of the St. Louis Fred data, as you can see, other than consumer, delinquencies still remain manageable in the industry. Almost all of the consumer-oriented categories lead, as you can see, but with CRE loans and business loans, that's still at 125 or less bips in terms of 30-day past dues. Again, this is as of first quarter of this year. There is some upticks in charge-offs in C&I loans that have kind of returned to pre-pandemic levels. As far as our traditional approach to looking at credit quality, our inventory, which is the non-performing loans chart to the left, is shown a slight uptick in the last year or so. Again, in this case, the Southwest and the Northeast kind of lead the inventory, but it's not anywhere near significant in terms of where we've been in the past. Charge-offs remain incredibly, although somewhat of an uptick, certainly don't appear to be out of hand. I mean, again, in my formal banking career, 35 basis points was kind of what we considered a threshold of concern. We haven't seen those kind of charge-offs in long time. In the more traditional way of looking at our reserves, which is, of course, under the current CECL is now deemed the allowance for credit losses to loans. You've got the bookends of the the West at the top of about 150 basis points, and you have the Northeast at the lower end, which is at right around 100 basis points. The more traditional way, or the more inverse way, the way I kind of look at it is how much of your acknowledged inventory are you being covered by reserves. Most of these are lumped together, but as you can see, there's a little bit of a trending downward. Again, remember, these are 10 billion and under bank assets. The QCBI index, we feel strongly at IntelliCredit and QwickAnalytics that so much of our customer base is in this category, and therefore we kind of carve off the mega bank data at the top, therefore not wanting to skew the relevance of it. But here's part of the story that I still remain a little concerned about it, because it probably conjures up some more scrutiny, frankly, by the regulatory authority, and that is when you've got this issue of the larger banks are clearly showing increased. Remember, they're showing lower loan growth, but they're showing larger increases in allowance for credit losses compared to the community banks. While their community banks are up a bit on a relative basis to the exposure to the loans they're looking at, particularly as you get the kind of growth that we've seen, as Sean alluded to, you got a downward drift in terms of percentage coverage of the reserves. The larger banks in particular, if we focus on CRE, their exposure in CRE is declining, while the community bank's exposure to CRE has increased. Again, this is nothing alarming about it, because we've got adequate reserves, as I've indicated. That's not even talking about the added cushion of capital that we've added since Dodd-Frank, but it certainly indicates that, again, given the community banks focus a lot on CRE growth, it is going to make us more the target of more scrutiny. In terms of the traditional concentrations we look at, nothing of a real headliner here. We've got the Southwest banks on the left side, which is the subset, 100% construction loan and development. As you normally would expect, the Southwest, Southeast states would probably lead this area because of some of the demographic growth going on there. There are 224 banks nationally that have exceeded the 100% guidance. Again, it's guidance, not regulation. The broader 100% guidance is also not significant. It's the West and the North East that lead in that percentage to risk-based capital. There are 331 banks that exceed the 300% guidance. Again, it just puts more scrutiny on you to defend your exposure to that. But I hasten to say, and we'll talk a little bit about this in a moment, if you're focused on these two particular measures, you're making a horrible mistake, because the regulatory community now is trying to look particularly at the subsets. That was one of the reasons we asked the polling question at the beginning of the session today, and that was, what CRE subsets concern you the most? That seems to be the theme of every regulatory inquiry we're hearing of late, and that is a clear focus on the CRE subsets, not so much as where you are on general CRE or even the more traditional focus on the construction and development area. Other areas of concentration, I was interested very much at how low multifamily was in the polling. To be frank with you, that's certainly growing in concern for me. It's certainly growing in terms of some of the data we're seeing, some of the objective econometric data, and some of the risk data that's coming out of some of the data banks, in terms of that loan product is particularly prone to becoming a bubble. And it's getting squeezed somewhat by the fact that it can't raise rents but so much higher. And then it's also getting the valuation degradation based on higher cap rates. C&Is, nothing particularly changed about that since the post-pandemic return to kind of normal C&I lending. And as you can imagine, as always, the Midwest would lead in ag and farm loans. Again, these are not farm credit system loans. So what does the credit landscape look like? Again, for many, many quarters, I've said this, the metrics themselves are still quite acceptable, but again, we have to be vigilant, because there is some indication that some of the credit stress may be increasing, and we have to be prepared for that. The servicing, again, the underwriting has never been better. The servicing is still a bit weak and spotty at some of our banks, as we see it in the loan review. There's no question that the rate and inflation environment have begun to take some toll on certain borrowers, particularly small businesses, and some, as we said, more consumer-focused lending. We've talked about this in the past, that we kind of got a bifurcated consumer base in this country between the so-called paycheck to paycheck, which is disproportionately bearing the burden of the rates and the inflation. And again, that's showing up in things like SBA loans, showing significant changes in their degradation of debt service coverage ratios, as well as in some cases delinquencies. We have not seen this level of downgrades of credit in probably 12 years in terms of what we've seen in the last couple of quarters. Much of that downgrade in our loan review is not necessarily going to non-pass or criticized classified loans, but certainly seems to be migrating within mid-tier or acceptable pass to some of the lower pass categories. Again, regulatory scrutiny is not only being heightened, it is in some cases fairly aggressive, particularly on credit process issues. Things such as, how are you treating your subsets of CRE, and how is that being understood? And again, a lot of this, I think, certainly came from the 5 bank failures of last year. One of the reasons we cannot be totally focused on either immediate kind of, we seem to be living in a sawtooth environment around, one day looks like we might hit a soft landing, the next day we've got weaker job growth than anticipated. We just don't know. But the one thing we do know, that credit by its own nature is much longer term than what the Wall Street financial press tends to be focused on, which is much more short-term, quarter to quarter. One of the reasons that it leads to that proverbial, aircraft carrier turning not on a dime, but taking time to change course is that arguably we still got a $1.5 trillion CRE loans to reprice before the end of next year. Again, I alluded to this earlier, small banks loan growth has been almost exclusively CRE. And all other providers in the U.S. economy seem to be fleeing CRE. I've shown this chart several times in this session quarterly to the left. It basically shows how much community banks have taken more and more and more CRE exposure among all of the national lending providers. But I think also we alluded to this earlier about loan growth. If you look going back, and we don't have Q2 at this point, but Q1, for all banks, there was 2.4% growth year over year in first quarter 24, but at community banks, 6.7%. And again, almost all of that seems to be in CRE growth. So we've got one of the things that I certainly don't want to insult the intelligence of credit specialists on this call today, but here's the simplest concept I can state that needs to be revisited relative to your preparation for more CRE scrutiny, and that is treat CRE loan analysis as really two halves of the same walnut. One half we know how to do basically in our sleep, which is to underwrite the project and the borrower for repayment capacity. The one that's getting far more scrutiny now, and perhaps not as well done, frankly, by our industry, is that determining what the market's footprint in terms of supply and demand happens to be. That's obviously requires a far more dimensional, kind of econometric, localized econometric analysis. Again, for any type of CRE concentration, this is now the standard expectation that as much as you focus on the project itself and the individual borrowing entity behind the project, you have to companion that with significant amount of understanding and analysis about where is the supply and demand of the marketplace that you're lending these CRE products into. This is the huge focus right now of the regulators in CRE lending. We all know once that inflection point crosses between supply and demand, it takes us out of optimal lending territory to challenging lending territory. Specifically, what we've learned, unfortunately, with some clients who have been under MRAs on CRE issues of late, is to, again, focus on your subsets, make sure your MIS data is as accurate and as robust as possible, improve the econometric analysis, make sure your policies are up to date. Do not be using 10-year-old policies or policies that might have been designed to significantly induce a lot of CRE lending, i.e. things like 3 years interest only. Make absolutely sure your policies reflect current conditions and current expectations in terms of where, with all this focus on potential risk in CRE. Embrace multiple stress test modes, portfolio level, loan level. We've got a third I'll mention in a moment to you that we've been very happy to offer. Certainly expand your loan reviews, treat loan reviews specifically as a critical line of defense, and understand that much of this is kind of until these latter 2 points have been at the traditional credit administration, credit management level, lending level, but specific areas of significant criticism we also see is that regulators are going after senior management and boards for being a little bit either too late in the game or not very energetic about adopting strategic and capital plan changes relative to CRE circumstances and environment. And also that, remember the adage that if it doesn't show up in board minutes, it didn't happen. So make sure that your minutes and board meetings are replete with indications of how you're discussing CRE exposures. My final segment is to really touch on three areas that we feel very, very strongly about and have since the inception of IntelliCredit, and that was not only syncing but improving three areas. Loan review, obviously, we do a tremendous amount of that. It is a friendly agent of your bank, whether it's done internally or whether it's done by third parties. Make sure you treat them that. Remember, there is a proven empirical formula that says early detection of credit problems leads to less losses. Also, one of the things we've said before in loan review, ensure that whoever's doing your loan review has the skills and the experience to be credible, particularly have the ability to persuade perhaps even skeptical people within the bank. You can't do that by just young, inexperienced people. They may get the quantitative part of it credit, they just don't get the qualitative layout unless you've kind of been there, done that. In Portfolio Analyzer, we certainly have one of our key products that's getting huge amount of success now in Portfolio Analyzer is make sure you are beginning to rise to the level of some of the mega banks who have really done a better job, frankly, of mastering their portfolio analytics. Remember, it's your DNA. It's unique to your bank. It's a gold mine that you're sitting on. Do everything you can to mine that data and understand, giving you a heads up of where some of these credit weaknesses or hotspots are happening. And lastly, in stress testing, for many years now, our sister division, QwickAnalytics, of course, has had a very robust, incredible portfolio level stress test in terms of credit. And we now can proud to say at IntelliCredit, which has always been more loan level, obviously, idiosyncratic kind of private data focused, is that we now offer two options on stress test. One is the loan level, traditional loan level stress test, where we do compute probabilities of default, loss given defaults, and various scenarios. But also we offer during loan review what we call companion stress test, which is basically charging our reviewers with recalibrating key metrics such as loan to value and debt service coverages, and then extrapolating those within the sample of the loan review to their various impacts on the risk-based capital buckets associated with those loan types. So again, it's always a pleasure joining with you on a quarterly basis. And Sean, I will hand it back over to you, sir.
David, and yeah, just to reiterate, right, we're really proud and excited the progress we've been making with David's team at IntelliCredit around stress testing, as he mentioned, right? QwickAnalytics, we've always had the portfolio, excuse me, portfolio level credit stress test, but we recognize that for a lot of us, we do need that loan level analysis, and so as he indicated, you know, we can assist with that now in the either as you know, an add-on in the loan review as a companion or just as an individual engagement. And we're going to continue to work towards having it become even part of our overall application as well. Let me just see. I got a chat come in. Will we share the PowerPoints? Yes, we will. Again, just a reminder, we will send out a link to today's recording along with a copy of the PowerPoint in, you know, probably later tomorrow afternoon or first thing Wednesday morning. As David indicated, IntelliCredit continues to grow, so certainly welcome the opportunity to discuss not only the analyzer or stress testing or loan review with you. We'd love to show you how we think we can help you in a number of different ways. So certainly reach out to us for that. Again, most of you who are maybe new to IntelliCredit, as David indicated, we provide loan review services, but we've also built an application that again allows you to use the tool internally in-house for loan reviews or even annual reviews, and then has all that analytical capabilities that David touched on. I think one of the things that we're most proud of is how simple it is to get started. It is a SaaS service, so there's really just getting a flat file or a core export, and we can have you up and going in really a matter of days. So it's not a overburdening integration to get the tool up and going, and that's part of the reason we offer a 6-month free trial, because we want to essentially show you, we're going to put our money where our mouth is, right? We think this can really help you, as within your entire, whether it's credit administration or just managing, the loan team. But we want to show it to you. We want to help you build reports that maybe you're currently already using and make that process easier. We want to help you potentially build reports that you would like to have, but you currently can't easily generate from your core. So the whole idea of the 6-month free trial is to give you that time with us, where we're revisiting every month to see the reports that you have, what else you can share with us that we can try to replicate for you. And again, then collaboratively teach you how to use the tool, but build anything or assist you in building anything that you and your team may be interested in. So we certainly encourage you to request the free trial. Really, we just need an NDA and a share file link to get started. But again, we really are excited about the development of this tool and all the capabilities that it has within it. We have a couple of other webinars coming up at the end of the month as we become familiar to with our cadence. We'll have our a loan review webinar here at the end of the month, along with a webinar focused on stress testing, where we will talk both about QwickAnalytics capabilities and the capabilities within IntelliCredit. So certainly encourage you to register. As with all of our webinars, if you register, you will get a copy of the slides and a link to the recording if you can't actually make the day and time of the event. And then also we'll have our Coffee Talk monthly webinar in August as well. So a busy schedule here over the next couple of weeks, and certainly encourage you to take it. Andre, thank you very much in the chat, giving us a vouching for the analyzer. So really appreciate that. And thank you for putting that into the chat for everyone to see. Again, we're trying to, as best we can, share collectively all of our webinars that we do. So we do have the YouTube channel. There's a link at the bottom of this page where you can access that, and then you can obviously access it within QwickAnalytics as well. So we'll check here for any final questions or chats. Again, thank you very much for joining us on a Monday. We typically try to do these in the middle of the week, but this next couple of weeks are fairly busy, as you can see from our webinar calendar. So we felt like the only time we could get this in was today. So we really appreciate everyone taking time out of a busy Monday to get started with us. I don't see any additional questions. David, any final words before we let everybody get back to their day?
No, and I do want to double down on appreciating Andre's kind remarks. That was always nice to hear, because in the end of the day, it's really for you and your usage, and that's the way we developed it all along. So thank you so much, and again, always a pleasure being with you on this quarterly tradition.
Awesome. Thank you, David. Likewise, appreciate everybody's time. Email us at info@quickrate.com if you'd like to get a copy of the QCBI report, or have any questions about IntelliCredit, want a quote for loan review or a stress test, just let us know how we can help. And you can certainly always call us as well. So again, thank you very much, and we'll see you either hopefully later this month or again next quarter for our next quarterly webinar. Thanks so much and have a great day.